Is SFIX stock big opportunity or just big trouble? After all, it's down about 85% this past year. A big thank you to Dr. Fan, who sponsored this individual company analysis with an unrivaled video production purchase. You too can request a company of your own choosing in the link below. And so looking at SFIX, to understand what do they do, they're the world's leading online personalized shopping experience. So that means you tell SFIX about the style, what you're looking for. It's a quick and easy quiz, and then their stylists send you pieces in a box that reflect your style, fit, and price points, plus the expert guidance of using machine learning, artificial intelligence. After you get that initial fix, maybe it's a box of 5 different items, then you sort of open up this sort of freestyle experience where you can shop in your own personalized store. The way this model historically worked before this sort of freestyle experience was you would get this fix, this box. It might be a subscription once a month, once a week, once every couple of months, and you'd get a couple of items, but first you'd pay sort of a styling fee of, let's say, $20. And then you'd get these items, and if you didn't like them at all, you could return it all, get refunded. But if you liked, let's say, one item, you could take the styling fee and use it effectively as a credit against that item and sort of say, hey, I already sort of started paying for this. Why don't I keep this? Because this one item, it's really cool. And this t-shirt, oh, I love this shirt, or I love these pants, I love these shoes. This really fits what I was looking for. I have a really busy schedule. This type of clothing is just perfect for the season. This is exactly what I'm looking for. So for some folks, and you're talking about millions of active customers, this really resonates with them. They really enjoy seeing new things that are sort of curated to their personal taste. Now, that was historically their model of saying, hey, let's get you on some sort of subscription. They've been making a switch now to, hey, let's get you sort of as a subscription, or this fix where you sign up for the fix, but then after you get that fix, then you sort of have your own personalized store that you're shopping from, and they want to encourage that as well. So it's not just sort of a subscription driven business. Now, they have broadened out over time. It started off primarily focused on women, then they opened it up, to kids, men, then various different, categories within women. You're talking about maternity, petite, plus size. So saying, hey, let's expand our market, US, UK. And the key value proposition here is that it's an aspect of discovery. It's an aspect of discovery for around the 4 million customers that they have, where these customers can discover products that they wouldn't ordinarily find, that they might not have expected, and they go, wow, I absolutely love this. So that is a discovery win for them. And it's also a discovery win for these brands that might not otherwise get discovered. So you can see how this could create sort of a double-sided advantage, where these brands are eager to work with SFIX, so that way they can more easily be discovered among clients that might not otherwise ever hear from them. Now, SFIX is introducing their own brands over time, which should help their own margins. Effectively, hey, we're going to sell you the products that we also own. It's not going to say the SFIX brand. It'll say another brand, but you'll think, oh, wow, this is a cool brand. I like it, but it's probably higher margins for SFIX. Now, once again, they're talking about how the process, you're facing a changing business model, previously focused just on that fix, getting that box of items, 5 items. And keep in mind, if you get a whole box of items and you go, wow, I absolutely love everything here, I love all 5 items, they typically have different types of encouragement saying, hey, if you actually end up buying all 5 items, or however many are in your box, you can get a sizable discount on your total purchase if you end up saying you like them all. So there are these little tricks to encourage you to do the whole purchase for the fixes, and to keep the subscriptions going. Now, they've sort of made a change, as I've already mentioned, about how now clients entering through SFIX.com are directed to schedule a fix. It doesn't have to be a subscription, but it sort of gears that way of like, hey, when do you want this to come? Do you want it to start arriving every month? And so that's immediately after filling out the style profile / quiz. After that, then you get this freestyle shop where you can go, oh man, I really like all these different items. Let me add this. So I might get a box, but there's all these sort of one-off items I want to get as well looking at this. So they are sort of facing this changing model. The question is, what did the financials for SFIX look like? And looking at them, I'd argue, their financials, at least historically, really jumped out. I mean, they had hyper growth from 2015 to 2019. This business grew from $300 million in revenue to $1.6 billion in revenue, and all that time they were profitable. I mean, this is better than most software companies, folks. I mean, this is quite surprising from what I initially expected looking at this. I thought this would just be a money loser because I really didn't know much about Stitch Fix. SFIX is the ticker. And so this initially is a very favorable data point saying, wow, look at that consistent profitability and that hyper growth they've historically delivered upon. Core operating profits, the margins range from, let's say, low single digits to a high of, nearly 8-9%. So it shows you, potentially what this business could deliver upon. Now, more recently, the story hasn't been as favorable. You can see in 2020, they continued to grow around 9% active clients. In 2021, they grew nearly 20%, 18% growth, got to 4.1 million clients, active clients. But since then, they've been coming under pressure. And you can see it's down about 5% year over year to 3.9 million. And you can also see how revenue's been coming under even greater pressure, down about 8%. And so that is a real challenge because you're saying, wait a second, you're no longer this growth story. Now it's sort of, is it X growth? Or is there some sort of business transition? And once again, I've already mentioned this business is going through a transition. Management talks about how we are in a period of transformation. Transformation always makes me nervous because honestly, when I'm looking for businesses, I'm looking for businesses that don't have to transform. I'm looking for think about the best investments that have, Warren Buffett has ever made. Usually it's because it's like, hey, they found something that worked, and it's sort of like, hey, you have pricing power and you sell more units each year. When you have to transform, there's that risk that you don't pivot successfully. And so the odds of success with those types of situations arguably are much lower. So transformation for me is always sort of a word that makes me go, do I really want to be involved in this situation? So management's talking about how they're going through transformation from a fixed only business to a fixed plus freestyle ecosystem. So you're getting, instead of just that one box, hey, after you maybe get set up for a couple of months of orders, let's also hook you up with this sort of personalized store that you can now shop on. It's sort of like an exclusive membership now that you can shop on, but first you have to order your fix. Let's order that fix, and then you get sort of this freestyle store. They're saying this enables us to serve our clients' on-demand styling needs as well as to begin to acquire new clients through personalized shopping. So having their own personalized store. And they're talking about how this is a much greater market opportunity, 2 to 3 times bigger than, let's say, just getting that fix only, that subscription or that box, every month type business. So they're saying, hey, the market that we're tapping into is much bigger. Now, they're still working on it. So they talk about expanding Freestyle into a client acquisition vehicle is an iterative process. That means, hey, us marketing that you can have your personalized shopping store versus sort of this fixed subscription box. This is a different model that we're used to. So it's iterative, meaning we're not going to get it right. We got to experiment a few times until we can start actually gaining clients this way. And our marketing techniques talking about a personalized store might not be hitting the mark. And that's arguably what you're seeing here. And they're saying, look, establishing a fixed plus freestyle ecosystem. So it's fixed plus freestyle. That's what they're looking to do. Will take time and will not be linear, i.e. it's going to be a bumpy process. Make sure you got your seatbelt on. And management sort of talks about this from a favorable standpoint. I'm like, what? Management's saying today approximately 20% of freestyle first customers come back and purchase again within 30 days. I don't view that as particularly loyal. This is not a subscription business. So looking at any sort of traditional valuation metrics like price to sales or anything like that, and we'll talk more about valuation metrics towards the end of this video, looking at those metrics really aren't applicable to this type of business, in my opinion. What you're going to want to focus on is like, hey, what's the cash flow this can generate? And am I being compensated for this? Because arguably customers aren't really that loyal. So the challenge is, as you've seen the decline in customers and revenue, well, management has actually sort of kept advertising and sales expenses sort of flat or higher. And that's resulted in higher expenses as a percentage of revenue, despite the fact that their margins are actually heading lower, revenues heading lower, advertising and sales general and administrative expenses moving higher. That does not bode well for their core profitability. And you can see how their adjusted EBITDA margin, which had historically been, low single digits, somewhere between 5 and 2% the last few years, has now headed into significantly negative territory, around negative 7%, negative 36 million in EBITDA in the last quarter. This means they're going from cash flow generating to cash burn. That does not bode well. So where does Stitch Fix go from here. If you're looking for compelling investment ideas or want to take charge of your investment journey, consider unrivaledinvesting.com. Full disclosure, this is not financial advice. And so looking at it, well, what did management say on the last call in terms of their outlook, for the fourth quarter of their fiscal year? Well, they're talking about even worse declines, talking about 15 to 13% declines in revenue, which is significant. Looking at EBITDA declining, a comparable amount, around 30 to 25 million negative EBITDA. So once again, sizable negative cash burn. And they also talk about net active clients will be down, will continue to be down. And they're talking about, we're also facing sort of these macro challenges as well. So you have the supply chain constraints, global inflationary pressures. But you should be glad to know that they are optimistic about their path to capturing the opportunities ahead. I'm optimistic when I see the financials start coming through, but I'm glad they're optimistic. And so this is a real challenge here. You have a changing business model. You have increasing unprofitability. You have the declining, like the changing business model that's not hitting. Like this is it's going in the wrong direction. It's okay to change your business model and you're accelerating your growth or you're still growing. But when you're changing your business model and you're now unprofitable, then layer on the fact, and I've called this out in several macro videos, that this is a period of potential stagflation where customers are going to be saying, wait a second, I have higher energy, I have higher food prices, I have higher inflationary bills. Like, do I really want to spend money on this fix of clothes that I might not need? For me, I buy my clothes and then it's like, boom, don't need a new shirt for another few years. Don't need new pants for another few years. Like, so it is a very specific subset of the audience that wants this. Now, I'm not everybody. There's 4 million people that are like, yeah, I need to get my fix. I need to get my Stitch Fix. But, hey, maybe the fashion is your thing. So it really depends on your audience. The question is, how do you value Stitch Fix from here? And generally, when you think about valuation, there's a couple of main different ways. You have this sort of the venture capitalist approach, which is typically like hyper growth, but unprofitable, but you're tapping into this much bigger market opportunity. The next approach is sort of saying, yeah, the growth might not be hyper 50, 60, 100% growth. Maybe it's growing slower, 5, 10, 15%, but I'm going to pay a reasonable price for that. Then the next, approach is sort of cash cow, saying, hey, I'm just going to milk this for what it's worth. Maybe there's no growth, but I'm thinking about, I'm going to get that cash each year. And then the last one is like, okay, this business is declining. It's a liquidation situation. I want to make sure I got, CYA and I'm not going to lose too much, cover my rear type of thing. And so what's sort of the downside? Looking at Stitch Fix, you're probably asking yourself, well, which bucket does this fit into? And think about it for a second. Like, it's no longer the hyper growth story. It's not even growth at a reasonable price because you're facing a decline. And it's not a cash cow because they've sort of facing really tough periods now, really tough periods with cash burn. And you're not going to, liquidate this company. Like, what's really the assets? And we'll talk about that in a second. So I'd argue Stitch Fix is in this really tough pile of being in a turnaround situation where investors are like, hey, you need to deliver. Otherwise, like, if you keep cash burning, then folks are going to be thinking about liquidation, because you can't keep cash burning. Like, you need to turn this ship around now. And so this is really a turnaround story when I look at this. So then the question is like, well, what's sort of the potential and how should investors think about that? Clearly, some of the insiders are excited about it. Director Bill Gurley, he's also one of the founders of one of the leading venture capital firms. I believe it's Benchmark. He personally bought 1 million shares of Stitch Fix, a couple $1 million. So some folks are getting bullish about this, saying, hey, he's buying into it. Personally, I think this is a rounding error for Bill Gurley. I mean, his net worth is several $1 billion. So spending $5 million is sort of like maybe a nice lunch for him. So that's, that's not a serious bet of conviction. I don't really read into that significantly. I mean, if anything, he might be thinking, hey, Stitch Fix might need the cash later on, in which case, his firm might need to put up more capital, more equity in the future if they even want to go that path, or maybe he personally does it himself if he's that committed to it, in which case that's the time to buy Stitch Fix, or at least invest sort of in a primary into the company, like saying, hey, this company needs the capital. The money's going into it, versus just buying, shares on the secondary markets. And so looking at it, thinking about Stitch Fix, personally, I'm putting this in the too hard pile. Oftentimes I lay out a framework of hypothetical valuation framework. But here, let me share some thoughts on why I think this is too hard for me personally. So currently stock price is around $660 a share. That implies around a $700 million market cap. And this, as I already alluded to, is an investor's no man's land, because you don't have the hyper growth. You don't even have growth. You don't have the cash cow. And so it's sort of like, well, what am I really playing for? You're playing for a turnaround situation that arguably they're not even seeing, because their outlook most recently was even worse. So decelerating, worsening decline in their business from a couple percent to like 13 to 15%. So this is a really tough situation. No wonder why the stock's down about 85% this past year. It's still showing limited signs of a turnaround. I'd argue no signs. And there's really limited tangible equity value in a liquidation type scenario. So this really is an extremely tough scenario, because you don't really have that backstop in terms of a liquidation. I mean, maybe you have like $1 a share or something like that. Either way, it's a lot lower from where the stock is from here. The question is, maybe would there be some sort of suitor interested in buying the company like that? That honestly, if there's a potential acquirer, I'm not sure who would be interested in, and it's very possible I'm just missing a scenario there where maybe there's a couple of acquirers that would be interested that I'm missing. I just don't see why, though, especially in this environment. It's like, wait a second, we're facing a potential stagflation, and this is a product that is extremely discretionary. And it's already starting to show signs of sort of that economic turn, active customers declining. Like, really, this is what let's say an activist or, some sort of acquirer might be interested in? I'm pretty skeptical on that. Maybe I'm wrong. And then thinking about, well, what's the upside if you get it right? Previously this company was generating, let's say 20 to 60 million in operating income, let's say somewhere between 3, 4, 5, 6, some single digit percentage of revenue, operating income. So thinking about that, maybe, you're paying like 10 times earnings, maybe. So is that even that compelling? Now, let's say you're paying, let's assume you get, closer to, paying like 5 times earnings, which I'm not even penciling out, because once again, this assumes a turnaround. Like, you're paying for a double or a double plus like that. Honestly, I just look at this and it's just too hard for me. Like, I would rather, if I'm going to be investing in something, I'd want to be able to comfortably pencil out a scenario where I'm like, oh yeah, here I see a path to 300% upside, 200% upside. And, I see how they're going to do this over time. There's no transformation that I have to worry about. There's no like, oh, we'll see when business stops declining. Like, hopefully that'll be in the coming quarters. Like, that's just not the path I want to be on. If the company is declining, then it's like, okay, why is it declining? Is this a structural decline? Is this a transformational decline? Like, transformational decline, that bothers me a great deal, because that might mean like, hey, this might take a while. Management says non-linear in terms of how long it'll take. So it might be, a couple of quarters are bad, then hey, everything's great. So it's just too hard for me. I'd rather look for stories that make more sense to me, where I can pencil out greater upside, I'd argue more conservatively than potentially the bumpy ride that you're going to see in SFIX stock. And arguably, you've already seen a lot of the bumpy ride. So that's where I suspect, some folks are interested in saying, hey, this stock is down. It's down 85% this past year. It's down something like 95% from its high within like the last two plus years. And so folks might be thinking like, hey, is this the chance for a bounce or something like that? Once again, everything focused on fundamentals. And I would rather focus on a situation where I'm like, yeah, I'm confident that the fundamentals will be much greater in the years ahead, because you have this unrivaled value proposition, or you have this strong solution. And it's not like, oh, there's a transformational problem with this business that's might be addressed. We'll see. And so that's my challenge looking at SFIX. If you have a different opinion on it, or you have different insights, I'd absolutely love to hear it in the commentary. So please leave a comment if you have any thoughts. And thank you so much for watching Unrivaled Investing.